Warren Buffett, widely considered as one of the greatest investors of all time, recently reminisced about the 1929 market crash and the Great Depression, offering a valuable lesson for the next downturn. In this video, we will take a look at why Warren Buffett thinks that the crash will be worse than 1929. Warren Buffett is one of the world's most well-known and successful investors. He is well known for his value investing technique, which involves buying good companies at reasonable prices and holding them for the long term. With recession looming, many people are seeking Buffett's guidance on how to effectively invest for the future. A recession, according to Buffett, is one of the ideal periods to hunt for investment possibilities. Bad news is an investor's best buddy. He stated in 2008, it allows you to purchase a piece of America's future at a reduced price. He also recommends long-term investing, claiming that investors who avoid expensive and unnecessary fees and simply sit for a prolonged period with a group of large, conservatively financed American corporations would almost surely perform well. Businesses will definitely experience earnings snags, as they always have, he continues. However, most large corporations will achieve new profit records in 5, 10, and 20 years. To illustrate the concept, consider Coca-Cola, one of Buffett's most successful investments. Coca-Cola stocks peaked at just under $32 per share in 2007, right before the Great Recession. It plummeted to $19.55 per share in March of 2009. What has genuinely changed about Coca-Cola's fundamental business in the last year and a half? The corporation still had a successful product with global distribution and one of the world's most well-known brands. The firm altered very little. What changed was investor sentiment, or the impression of the company during a period when people were just scared about their economic future. Those that saw past the fear and purchased shares were rewarded. Coca-Cola stock is currently worth more than $63 per share. Buffett instills confidence. We're still in a recession, he told investors in 2010. We won't be able to leave for a time, but we will. Nothing is permanent. Therefore, even if it appears that the economy will continue to deteriorate, keep in mind that there is a light at the end of the tunnel. Buffett recommends investing in oneself as one piece of advice. While this does not concentrate on stock investing, it does pay dividends. The finest you can do is to excel at something. Buffett advises, in exchange for what you deliver, others will give you some of what they make. Your education and talents will be recession-proof. You can cook in a good or poor economy. If you learn how to cook, if you learn carpentry, you can construct things in both good and bad times. Sometimes the best approach to invest is to put in the time and effort to learn a new talent that you may use to gain money later on. Warren Buffett is one of the most successful investors of all time, which implies that just following his recommendations will not result in the same level of success. Listening to his advice, on the other hand, can help you construct a profitable portfolio. First and foremost, investors should remember his remarks regarding recession and the opportunities they bring. Buffett tells investors to be afraid when others are greedy and greedy when others are afraid. Recessions are periods of fear, so investors should look to buy up on stocks at rock-bottom prices. However, Buffett recognizes that many consumers lack the time and experience to locate the finest investing possibilities. In 2020, during a shareholders meeting held virtually due to the COVID-19 pandemic, he said, "In my judgment, for most individuals, the best thing to do is owning the S&P 500 index fund. People pay a lot of money for advice that they don't really need. You do significantly better than buying treasury securities if you bet on America and hold that position for decades." It's easy to understand why. The S&P 500 has provided an average return of about 10% over the last century, for an inflation-adjusted return of just under 6.9%. Investors who keep it simple and continue to invest in wide index funds, even during downturns, have a better chance of success, doubling their money nearly every decade without needing to spend hours poring over market data. The 1929 stock market crash and the subsequent Great Depression was a defining moment in world history. The crash, which took place on October 29, 1929, saw stock prices plummet and the stock market lose over $30 billion in one day. The depression that followed lasted for a decade and had a profound impact on the world economy, leading to widespread unemployment, homelessness, and poverty. However, the Great Depression also taught some valuable lessons, which are still relevant today. Warren Buffett, who was born in 1930, has shared his thoughts on the subject, stating that the crash and the depression taught him the importance of being prepared for the next downturn. One of the key lessons that Warren Buffett learned from the Great Depression is the importance of patience. During the Great Depression, many investors panicked and sold their stocks, leading to further declines in the market. On the other hand, those who were patient and held on to their stocks were able to reap the benefits of a rebound in the market. By being patient, investors can avoid making emotional decisions based on short-term market fluctuations and can focus on their long-term goals. Another important lesson that Warren Buffett learned from the Great Depression is the importance of diversifying one's portfolio. During the Great Depression, many investors held all their eggs in one basket, and when the market crashed, they lost everything. By diversifying their portfolios, investors can spread their risk across multiple assets and industries, reducing their exposure to market downturns. This can help investors weather the market downturns and minimize the impact of losses. Warren Buffett has emphasized the importance of having a long-term investment strategy. He has often said that the stock market is a device for transferring money from the impatient to the patient. By having a long-term investment strategy, investors can take advantage of market fluctuations and reap the benefits of compounding over time. This allows investors to stay invested in the market, even during downturns, and to take advantage of the opportunities that arise when the market eventually recovers. Value investing is an investment strategy that involves buying stocks that are undervalued relative to their intrinsic value. The idea behind value investing is to buy stocks that are undervalued by the market and hold on to them until the market recognizes their true value. By focusing on value, investors can avoid overpaying for stocks and reduce the impact of market downturns. Warren Buffett has been a proponent of value investing for many years and has used this strategy to build his wealth. He believes that by focusing on value, investors can reduce their risk and increase their chances of success. During the Great Depression, many investors bought stocks at high prices and then saw their investments decline significantly when the market crashed. By focusing on value, investors can avoid overpriced stocks and reduce the impact of market downturns. Another important lesson that Warren Buffett learned from the Great Depression is the importance of avoiding debt. During the Depression, many companies went bankrupt due to high levels of debt, which made it difficult for them to weather the downturn. By avoiding debt, investors can reduce their risk and increase their financial stability, making it easier for them to weather the next downturn. Debt can increase the risk of an investment by making it more vulnerable to market downturns. When an investment is highly leveraged, a small decline in the market can lead to significant losses. By avoiding debt, investors can reduce their risk and increase their financial stability, making it easier for them to weather the next downturn. Finally, Warren Buffett has emphasized the importance of staying calm during market downturns. During the Great Depression, many investors panicked and made impulsive decisions, leading to further losses. By staying calm and avoiding emotional decisions, investors can avoid making mistakes and preserve their wealth. Staying calm during market downturns can be challenging, but it is essential for success. By avoiding emotional decisions and focusing on their long-term goals, investors can reduce the impact of market downturns and increase their chances of success. By taking a long-term perspective and avoiding impulse decisions, investors can emerge stronger from the next downturn and build wealth over time. Over the course of his long investment career, Warren Buffett has provided sound counsel. Given his accomplishments, it's reasonable that people would look to him in the event of a recession. The good news for regular folks is that his advice is very simple. Diversify your investments and don't worry. And with that being said, it's time to end our video. Subscribe to the channel for more amazing videos like this. We'll see you with another interesting video.